Good morning to those in the United States and good evening to those who are in Japan. And I am Takatoshi Ito, Director of the Program on Public Pension and Sovereign Funds at the Center on Japanese Economy and Business, or we call it CJEB at Columbia University. And I'm also a professor at School of International and Public Affairs. We call it SIPA at Columbia University. On behalf of CJEB Director David Weinstein and our chairman, Hugh Patrick, I welcome you all to today's webinar, ESG Investing in the COVID-19 era. All of us at the CJEB truly appreciate your participation today. And despite these difficult times we are all facing due to the COVID-19 pandemic. I would also like to take a moment to thank all of CJEB's sponsors for their generous donations and support. Now, before I go into more details of today's event, let me talk about CJEB. The center was established in 1986 by Professor Hugh Patrick, who is now chairman at the center. And it is now led by Director Professor David Weinstein. CJEB's mission is to promote knowledge and understanding of Japanese business and economics in an international context. As a research organization, widely recognized for its vigorous research activities, international symposia, conferences, and lectures held both in New York City and Tokyo. We provide prominent speakers from the public and private sectors, a forum for collaboration and reflection on Japan, the United States, and the global economy. We are currently the only research center which specializes in Japanese economy and business in the academic setting in North America. We are proud of that. We continue to pursue our mission in the world of new normal with evolving tactics and techniques. Today's webinar is a part of the Japanese economy in the COVID-19 era series. This series of 5 remarkable webinars in response to the COVID-19 pandemic are about moving towards and improving our new normal. The first 2 were conducted in Japanese and generated a great deal of interest and discussion. Now we are moving into the spoken English portion of this series, and we are looking forward to the same level of success and quality of discourse. Today's webinar will be one of the 3 in the next several weeks that will be conducted in English. We go into more details about the upcoming events at the end of the seminar. Now, today's topic in ESG investing in the COVID-19 era. ESG has been a very popular theme in our annual CJEB conference on public pension and sovereign funds. I think ESG is a very interesting concept, and I understand it is gaining popularity in asset management world. But let me abuse my privilege of giving this introduction. And as an economist, as opposed to practitioners of asset management, I confess my puzzlement about ESG, not as individual ESG, but as a package of these 3 important issues. For economists, E represents the issue of global public goods and externality. And we typically recommend government intervention, like taxes and subsidies, to correct the so-called market failure. Private actions usually suffer from free riders problem. S also represents some kind of externality problem in the society. Your irresponsible behavior may hurt the society, but you will not be immediately penalized for these actions. A typical economic solution is to make unethical behavior explicitly illegal or punishable, instead of placing social pressure on behavior. G is easy to understand from microeconomics point of view. yes, shareholders' self-interest would be sufficient to make changes in G with a condition of transparency and prompt disclosure. So ESG represent very different problems to economists. And we are puzzled why this package is so popular in asset management world. So that's my sort of impression from economics about ESG. But my role now is to introduce Keiko Honda, who's an expert on this ESG issues, and she will conduct the discussions with other distinguished panelists, whom she will introduce. Keiko Honda is an adjunct professor at the School of International and Public Affairs at Columbia University, and she is the former CEO at the Multilateral Investment Guarantee Agency, that is MIGA, of the World Bank Group. Keiko, thank you very much for being here today, and the floor is yours.
Well, thank you very much, Professor Ito, for very interesting issue raising. To me, somebody like me, kind of living between the public sector and private sector. Also, thank you very much for a kind introduction. So, good morning for the people joining from the US. Good evening for people joining from Japan and the rest of the Asia. I'm very happy to have such a large audience from many parts of the world. I appreciate it if today's discussion was off the record. In the event you would like to quote some part of today's webinar in public or on social media, could you please check with us by writing to cjeb@columbia.edu. Thank you in advance. Today's theme is ESG investing. ESG investing has existed for a long time. Some institutional investors engage in socially responsible investing as early as 1928. But it has become very popular in the last several years. With the new challenges brought on by COVID-19 and increased concerns about social justice and equality coming to the fore, I am hearing that ESG is evolving to take these new challenges into consideration. Today, we are very lucky to have two very wonderful guests who have practical knowledge to engage ESG investing and are the thought readers, Cathy, Matsui, and Ronald. Since we have a broad audience today, before inviting Cathy and Ron, let me quickly share with you what we have discussed about ESG investing in the class I taught recently at Columbia University in SIPA. So please allow me to use the chart. Let me quickly do 2 minutes quick clash course with no test, no tuitions, but no credit. So at Columbia, we have discussed 3 issues. First one, what is ESG investing? Is it different from responsible investing, impact investment, philanthropy, and SDGs? Second issue is why engage in ESG investing? And then third one is where is ESG investing is heading, especially after COVID-19. First issue, what is ESG investing? Unfortunately, ESG investing, we don't have a one single agreed definition yet, but some asset managers define ESG as follows. Environmental, social, and governance factors are non-financial considerations that are important for stakeholders to keep in mind when assessing a company's performance, and can be used both to mitigate risk and unlock opportunity in an investment portfolio. One thing I can really say is ESG is very different from the philanthropy, where we don't actively seek the financial return. Impact investment is a slightly different animal. It is defined by IFC, International Financial Corporation of the World Bank Group, that are investments with the intent to contribute to the measurable positive social or environmental impact alongside financial returns. There may be a little bit of overlap between impact investing and ESG investing, but it's a little different things. And I understand that responsible investing is a part of the ESG investing. Also, SDGs. SDGs, by some reason, some of the people in Japan are confused about those two. SDGs, or Sustainable Development Goal, is the 2030 Agenda for Sustainable Development Goals adopted by the United Nations and its member state, along with a number of the private companies. So ESG and SDGs, I have to say, are not the same thing. So I'm today very much looking forward to hear from Cathy and Ron regarding their definition of ESG investing. Number 2 issue is why to engage ESG investing. I have interviewed 20 asset owners, asset managers, and banks in the US, Europe, and Japan during the last 7 months about this issue. Single most common answer was potentially improve long-term return. Prior to the COVID-19, many academic papers, except for the few, stated they haven't found a lot of excess returns. But I understand that a number of ESG indexes outperformed last 6 months. So I also like to hear that, probably this area more from Ron. And then last issue is the where is ESG investing is heading. Many of my students expect ESG investing will play a larger role in the future. Many expect social factor to be more important. We would definitely like to hear from Cathy and Ron their perspective about ESG investing in the future. So it is my honor to introduce Ron. He is the chairman and CEO of State Street. Prior to joining State Street, Ron was the president of Asset Management and Corporate Services for Fidelity Investment and president and chief executive officer of Bonnie Mellon Asset Management and a vice chairman of the Bank of New York Mellon. Before that, he was partner of McKinsey & Company, and he was my boss. Let's welcome Ron. Thank you very much.
Thank you, Kiko, and thank you for that kind introduction. And I can assure you I wasn't Kiko's boss. Kiko was a tremendous colleague and was a great part of my McKinsey. Japan's been and remains a very important part of our strategy. I've been traveling to Japan myself for decades, normally would be there every 6 months. I haven't been back since November because of the current COVID, but for us at State Street, it's very important. We're the largest non-Japanese trust bank, and we've got about 500 employees there. It's a very important part of what we do. At State Street, we've been involved in some form of ESG investing or its priors for nearly 30 years. So we've both followed and led the evolution of it. It is clearly, as Keiko notes, become more pronounced over the last few years, and it's really driven by three things. First is client demand. Second is just a growing body of good research that's linking ESG issues to material investment risk and opportunities. And finally, just a greater regulatory focus, particularly outside the United States, on certain ESG issues. In terms of ESG in the COVID-19 era, our view is that the current health crisis and economic fallout are actually focusing investors more on these ESG and related kinds of issues, particularly on corporate resiliency. And we believe that this kind of focus on resilience will actually increase the focus on ESG issues more broadly. So I'd like to spend a few minutes just talking about how we think about ESG investing at State Street and what we think the future looks like. Firstly, maybe a definition, because as Keiko notes, everybody defines ESG in their own way. We think about it first and foremost about managing risk. It's a risk factor in an investment risk framework, and about better transparency into both tangible and intangible long-term value drivers for companies. It's about understanding material environmental, social, and governance issues that may impact a company's ability to generate attractive long-term returns. And to that extent, we believe that ESG is very consistent with what investment managers are meant to do. If you think about what an investment manager is meant to do, it's meant to generate a return on invested assets according to the guidelines presented by the client, and to identify, evaluate, and manage risk as part of the ongoing buy, hold, or sell decision. This is especially true for managers like us that are also very large index managers. So we will own companies on behalf of our clients as long as they remain in the index. So for us, this hold phase and the analysis of what a company is doing from an ESG perspective is actually quite important. So long-term investors, whether they're index managers like this or a pension plan like GPIF, they have to look forward and look ahead to risks that might impact the value of their investments over the long term, recognizing that they have to hold these investments for that long-term horizon. So while there's a growing proliferation of ESG investment products that are out there, we believe that ESG considerations will actually become mainstream. So rather than thinking about ESG in terms of, well, I'll go buy a product that's ESG, we think increasingly you're going to see ESG considerations be part of the overall risk framework and overall asset allocation for investors. And in some cases, they already are. I mean, think about it. I don't think many people would agree with the G portion of the governance portion of ESG investing. I think everybody would agree that good governance is critical to actually achieving good financial returns over time. And that's actually why our asset stewardship team, which oversees what we do vis-a-vis the portfolio companies that we invest in, that they focus on board issues like diversity and an effective and independent board leadership. For the E portion, our investment managers also focus on environmental issues as a value-driven imperative, not a values-driven imperative. And what I mean by that is everybody on this webinar could have a different opinion on, for example, climate change. And it's not our role to get into the politics of that, but it is very much our role to ensure that boards who oversee these companies are making sure that management is looking at climate change from the perspective of the long-term value of the company. And this is why at State Street, with nearly 1,000 other public companies around the world, we've adopted the principles set up by the Task Force on Climate-Related Financial Disclosures, or TCFD, to drive more transparency around this issue of climate change. And finally, when it comes to the S of ESG, it's perhaps the more challenging area because it refers to intangible value drivers, such as corporate culture and how a company manages its employee its supply chain, its role in the community, but nonetheless, we see it as very, very important to long-term value creation. Let's talk about COVID-19. We think that the COVID-19 is actually magnifying the importance of ESG. It's bringing forward things like resilience, cultural characteristics like agility and innovation that allow companies to actually respond to a crisis like a pandemic. We actually work at State Street with George Serafim at a competing institution. Harvard Business School he's one of the leading thinkers on ESG investing. And he's done some interesting work actually over just the last few months, taking a look at the stock performance of 3,000 global companies during this time of market volatility. And what he's found is that there's a strong correlation between those companies with strong ESG characteristics around things like protecting supply chains, maintaining employee health and morale, loyalty and engagement, that they've showed actually a smaller decline in their share prices than others that have weaker ESG characteristics. So the message that we're seeing is that investors increasingly want to align around strong ESG performing companies. The challenge that we have, and that you'll hear from most investors, is that while many have offered products over the years, if you recall, we used to have these products called socially responsible products, and they were basically what I call negative products, right? They wouldn't invest in certain things, be it guns, tobacco, things like alcohol, things like that. It then moved towards what I call positive investing, where you would seek out companies that reflected the kinds of value that you thought was important, such as gender diversity, low carbon, et cetera. Increasingly, large, sophisticated investors, I think, want to integrate this into their entire portfolio, into their entire asset allocation. We believe that's a good trend. The challenge in it is the lack of high quality and consistent data. And there we're still in the early stages, and I think you'll see that you'll hear that complaint on the part of many, that to really make the pivot and have this truly incorporated into what investment managers do, that we need better data. Our view is that efforts like the Sustainability Accounting Standards Board, or SASB, TCFD, as I talked about earlier, are actually critical first steps, and it's really important work to get there. Maybe I'll close and turn it back to Keiko by really commending the leadership role that Japan has played in the realm of ESG. We have an equities team in Japan. They are constantly commending the extraordinary performance improvement that they've seen in Japanese companies in a relatively short period of time on all elements of ESG. We salute Prime Minister Abe's efforts to bring more women into the workforce and to promote women in leadership roles. We are one of the founding members of the 30% Club in Japan, and that in itself is moving along. And then lastly, I want to acknowledge the very critical role that GPIF has played in requiring their investment managers, such as us, to explain how they are incorporating ESG into the investment decision making. That kind of challenge makes all of us better. So we believe the efforts coming out of Japan are galvanizing the industry. They're having a global impact. And I think it's important that all of us be doing what we can to drive ESG forward. So with that, I'll hand the program back to Keiko.
Well, thank you, Ron. It's extremely interesting, making extremely interesting points. Now, let me introduce Cathy Matsui. Pretty sure like most of you know her very well, but Cathy is the Vice Chair of Goldman Sachs Japan, co-head of macro research in Asia, and a Chief Japan equity strategist. She's also invented the concept of Womenomics. Let's welcome Cathy.
Hi, everybody. Thank you very much, Keiko and Ito Sensei, for inviting me for this webinar. And it's a pleasure to be on the stage with Ron as well. So I thought what I would do is cover 3 points in particular. First off is because I sit here in Japan, is briefly talk about what's the evolution of ESG investing in Japan's market. Second, talk a little bit more about the progress and work that still needs to be done on the G of the ESG, i.e. the governance front, because I think there's been, as Ron mentioned, considerable strides made in this part of ESG. And then finally, as Keiko mentioned, I thought I would perhaps update everybody on what's been happening on the gender diversity Womenomics front and what still needs to be done there as well. So if the slide, I have the first slide can be displayed, please. Thank you. This next one. So if you look at the market for ESG investing or sustainable investment assets in this market, as you can see in this graph, without looking at the tiny numbers, it has simply exploded. So compared to less than 1 trillion yen of sustainable investing assets about 5 years ago, it's now climbed to over 330 trillion yen. That is, by the way, about 2/3 of Japanese GDP. And making Japan really, in a very short space of time, I think it's the 3rd largest ESG market in the world. This is now, I am told, about 18% of all investable assets in Japan's market, which sounds very high. But I also understand in jurisdictions like Australia and New Zealand, that ratio is as high as 60% plus. So for those who think that there isn't much more growth or room for growth here, I think that is incorrect, and there's still plenty of potential for growth. The second point, though, moving on quickly, is of the E and the S and the G, our colleagues in Goldman who work on something called the GS Sustain research product, which really incorporates ESG into investment analysis. They looked at Japanese companies in the context of other global companies and measured these 3 letters and found that in general, Japanese companies actually score reasonably favorably with other companies in the US and European markets on the E and the S, but the G, of course, is more behind the curve. However, since 2014, as many of you know, thanks to, frankly, the government, and particularly the FSA's push to improve corporate governance standards, there's been remarkable improvement. Just to give you some history, 2014, Japan adopted the Stewardship Code. 2015, the Corporate Governance Code. By the way, in 2050, Pakistan had already had a corporate governance code, so Japan only introduced one 5 years ago. As Ron mentioned, the GPIF, the world's largest pension fund, became a signatory of the United Nations Principles of Responsible Investing. And this really, I think, put pressure, as Ron said, on many Japanese asset managers to adopt and start to engage with their investee companies. So what's happened since these reforms? On the next slide, one very visible change has been the independence of Japanese boards, which I used to call an oxymoron. There wasn't much independence when I started my job 30 years ago, but as you can see in this graph by the bars, almost all Japanese listed companies now have at least 2 independent outside directors. And I also drew this red line, which shows you the number of companies with accounting scandals. And I make the case that I do not believe these 2 trends are accidentally correlated, but I think there's actually causality here, because the more outside and independent voices on a board, the greater the ability, I think, to suss out improprieties and things like this. We're also, if you look at the next slide, seeing a burst of activity from what we call activist funds. We have seen a tripling, in fact, of activist funds investing in Japan's market, as you can see in the orange graph on the left. And on the right, we're also seeing, very encouragingly, a record number of shareholder proposals being proposed not just by foreign investors, but very encouragingly by Japanese domestic investors. And I think this is a really important point, that the Japanese institutional investor community is shifting away from being a so-called silent stakeholder to a more outspoken shareholder. Next slide, please. And as a consequence of this greater engagement, what have we seen as outcomes? Well, first of all, if you look at this graph, this is a graph combining dividends and share buybacks. Japanese companies in the Tokyo Stock Exchange, for instance, over half of them have net cash positions. That compares to similar ratios in the US and European markets, which is well below 20%. There are many companies in Japan that have more net cash than their market capitalizations, which would immediately be, sort of takeover opportunities in most other markets, but not the case in Japan. So with this excess cash and the fact that interest rates are zero here, we are finally seeing some of that investor pressure being applied and forcing, or strongly encouraging these companies to give back some of their excess cash to shareholders through both buybacks and dividends in record levels. And the other thing I want to explain is that another very popular, I think, tool that companies use to kind of fend off potential takeover threats was poison pills. But interestingly, today, there are actually more companies that have eliminated their poison pill structures than that still keep them. So I think this is also probably a positive outcome as a result of this greater and better governance and greater pressure and scrutiny from shareholders. But not all is perfect, of course. If you go to the next slide, there's still room for improvement. A couple of areas I want to highlight. First is what I call compensation governance. And this may sound a little bit puzzling to you, but I think at the end of the day, you get what you pay for, so to speak, when it comes to incentive compensation. Many Japanese companies, if you look at their CEO pay, which is on the left, and compare it to CEOs in other jurisdictions, the US is in the middle, European CEOs on the right. But they simply not only get paid very little, but if you look on the right-hand graph, which I think is more important, the top bars of those columns represent incentive pay or bonus kind of related pay. And as you can see here, Japanese CEOs, about half of their pay is still in base pay versus maybe 10% of US CEOs and 29% or so of European CEOs is base pay, meaning that Japanese CEOs do not actually have too much variable compensation to reward them for taking appropriate risks to restructure their companies or whatnot. So we also have a problem where only 54% of all TSE1 listed companies have compensation or nomination committees. That is not the par for the course in this market. We are seeing more companies adopt compensation committees, but in many cases still, the CEO actually hankos, rubber stamps his own pay, which of course raises a lot of governance issues. So we are moving in the right direction slowly, but there's still plenty of, I think, improvement there to come. Next slide, please. So what's COVID done on this aspect of governance in Japan? Well, from my perspective, I think it is forcing many companies to take a very hard look at their own business structures. For instance, we are now seeing a record number of TOBs, takeover bids, and in particular, Japanese companies, for instance, buying in their listed, what we call children, their listed subsidiaries. We've had some very high profile cases of late, and I think this is a very good first step in terms of consolidating their own businesses and streamlining. We're also seeing more Japanese companies really looking abroad for growth markets. And I think we're also going to see more consolidation within Japan, companies buying up each other or joining forces with each other, because I think one of the biggest gaps between Japanese ROEs, which tend to be much lower than the returns on equity of US and European companies, is that Japanese corporate margins tend to be very thin. Why are they so thin? Because there's not enough industrial consolidation, in my view. So I think the crisis is going to galvanize more consolidation on that front. But of course, the big burning question is, does this all matter? Does this matter that you have companies with better governance versus worse governance for the bottom line in terms of share price performance? If you look at the next slide on the right, you will see that we've actually come up with a framework of really scoring Japanese companies on the basis of a range of governance related metrics. And while the data, of course, still has a lot of issues, as we all know, if we look at the top 50 versus the bottom 50 companies on this basis, we can prove indeed that those Japanese companies that tend to have higher than average governance scores tend to do better vis-a-vis overall performance. Next slide, please. Final point is on Womenomics, and this of course relates to the S and the G of ESG. And we all know that Japan has not historically been very known for its emphasis on diversity, but we have seen quite a dramatic shift, in my view, over the last several years. If you look at the left graph, the red line represents Japan's female labor participation rate, which used to be one of the lowest in the developed world. not that long ago, and now it's shot up to over 71%, which is much higher than the United States, 67%, and that of the EU as well. So the numbers of women who are able to work, who are now working outside the home, is at a record high. Over 3 million jobs have been created since 2013. And on the right side, we're trying to conduct sort of a hypothetical analysis. What if we could close the gender employment gap? On top of that, we know that a lot of Japanese women that are working outside the home are working part-time roles, not full-time ones. Let's imagine that female to male hours worked ratio actually converges to the OECD average. If we combine these two things, what could be the prize? The prize is Japan's GDP could be lifted by as much as 15%, which is huge in my view. And on the next slide, just looking at some of the areas of progress, I've already mentioned the record levels of women in the workforce. Japan's also done some good in terms of expanding childcare capacity by about 30%. We probably have the most generous, among the most generous parental leave benefits in the developed world. Many people don't know that. And then finally, transparency, very important when we're talking about ESG as a subject. In 2015, the government passed legislation which forces companies and organizations to disclose gender-related statistics and disclose targets related to that. No other jurisdiction that I'm aware of has that requirement. Yes, the data is imperfect, it's still on a voluntary basis, but many listed companies do provide this data, and I think it's been a very important improvement. What still needs to happen though, which is this X on this graph, is women in leadership. Only 10% of parliament, lower house, is female. 13% of business managers, female. Maybe 6 to 7% are female board directors. So still a very, very long way to go. I actually just published a book that's out since last week, Tips on Managing Female Employees. Why did I write this book? Because this is where I think the next stage needs to happen. We need to work inside organizations, training managers and training female employees on how to nurture them, how to raise them to positions of higher responsibility. Next slide, please. And we also showed that there is a business case for diversity and for Womenomics. And as you can see here, it is positively correlated. The higher the female manager ratio is, the higher the sales growth and the ROEs on average. And the last slide shows you the graph of performance as well, just isolating those companies with very strong diversity statistics. Back over to you, Keiko.
Well, thank you, Cathy. Thank you very much for sharing with us how Japan making a progress, Japanese company making a progress, ESG, including Womenomics. By the way, I would strongly recommend all of you, all of the audience, to read Cathy's new book. This is not just kind of raising the issues, rather talking about how to develop women as a reader in your organization. I think it's definitely worth reading it. It's available over Amazon. Okay, I got a lot of good questions. So therefore, let me start asking some of them. First question is to you, Ron. You talked about ESG has changed, or it's changing the US corporates and many corporates around the world. But ESG is not a new, but it's gained popularity recently. What were the driving factors to increase ESG investing in the US and Japan before COVID-19? Last August, the Business Roundtable, made up of the CEOs of many large US corporations, redefined the purpose of a corporation and announced a commitment to lead their corporations for the benefits of their employees and society, in addition to the shareholders. I'm actually quite surprised about the announcement. I'm pretty sure everybody did, since I saw FTs and Wall Street journals, everybody was writing about it. The question is, how did this move influence ESG investing?
Well, I mean, there's a lot to your question there. I think that, there's been a series of things that have happened, not just over the last few years, but over the last few decades, that have really made this push to ESG. if you think about the G side of it, we've had, many governance failures over time. You go back to the, some of the WorldCom failure, the Enron failure, which were really failures of governance, failures of board to oversee managers, and failures of investors to understand what was going on. I think you've also seen increasing pressure on companies to be responsible, not just for profits and returns, but for some of the cost, the externalities, if you will, that they're imposing on society, particularly as it relates to environmental concerns. So there's been this increasing pressure on it. I do think part of what's really propelled it is in the rising popularity of index investing. Because if you think about index investing, you will be invested in a company as long as it's in the index. So it's truly permanent capital in the public markets. And because as an index investor, you don't have the ability to disinvest, you actually have to, since you're holding the company for as long as it's in the index, you have to engage with the company to make sure it's doing the things that you believe will drive long-term investing. So I think it's that combination of things coupled with, you've had some regulatory activism, particularly in Europe on this point. And finally, you've got changing views of investors. I mean, we spend a lot of time trying to understand what different cohorts and generations of investors are thinking about. And the younger investors, millennial investors, are very concerned about not just what their return is, but how their money is being employed. So it's a series of factors that I think are driving this. In some ways, the Business Roundtable was catching up to what was already a well-known and well-defined trend.
Thank you, Ron. That's extremely helpful answer. And then next question is to you, Cathy. Well, thank you so much for elaborating the progress of the G as well as the also Womenomics side. If you just look at the Womenomics from the ESG standpoint, what kind of role is Womenomics playing in ESG investing? If you can elaborate a little bit more on that, that'd be extremely helpful.
Sure. So in, again, Japan's context, if I may, we have seen, thanks to the provision and disclosure of data that I mentioned earlier, albeit imperfect, companies are now coming up with better quality data than they ever had before. And so, for instance, the GPIF, I believe it was in 2017, made a big announcement that they were going to invest trillions of yen into ESG leading companies and gender diversity leaders as well. MSCI has created, in fact, because this data was available, finally, I think it was called an Empowering Women's Index. And that was an index that the GPIF put money behind. Well, as soon as the GPIF puts money behind something, as I said earlier, most of the asset management community in Japan tends to follow that lead. Secondly, we have seen institutions like State Street, BlackRock, GSAM, Goldman Sachs, and proxy advisors like Glass Lewis get behind gender diversity in a way that really improves board diversity. We don't need just independent outside board members, but we need to make sure they're coming from, different, perspectives in terms of gender. And so many of these institutions are now requiring that at least one or more of their board members be female. And if they're not, then they would automatically, cast a no vote, for instance, against the management or the board or whatnot. And so I think in this respect, gender diversity and Womenomics is starting to play a pretty big role vis-a-vis, at the end of the day, what Ron mentioned earlier. This is all about, risk management. And if you have a board that has no diversity of thought, comes from the exact identical backgrounds, they may have really fun meetings together, but if nobody speaks out and nobody blows the whistle on improprieties or things like that, then we've got an issue in terms of obviously governance and fiduciary responsibility. So I think it plays a huge role.
Well, thank you. That's extremely helpful. A lot of people kind of saying COVID-19 forcing us moving us from the just in time to just in case. So I'm pretty sure like a diversity of the board will help that dimension. Next question is how the COVID-19 and Black Lives Matter influencing ESG investing. I think both of you, as I know, touched upon when you actually spoke in the beginning, but can you just give us a little bit of more your view, your perspective, what kind of change will be happening S and G? This question goes to Cathy and Ron. Maybe I think give a breath to Cathy and ask Ron to start.
Yeah, so I mean, I think that COVID-19 is obviously a truly pervasive factor now affecting the entire world. I think it will put a lot of focus on ESG. What are some potential areas? Certainly around company resilience and this idea that that companies need to be prepared for the long term and need to acknowledge that black swans actually do exist. We can never define what they are. And if you think about some of the the business failures that we've seen, or the near failures, I mean, I'll just think about the airline industry. I don't think anybody could have expected the airline industry to have foreseen this. On the other hand, the airline industry has suffered from a series of unexpected events over the years. I mean, you think about SARS, which was COVID-19 on a smaller scale, or for that matter, 9/11. And what does it mean for what should the capitalization of that industry be? You know, what kind of leverage should it be carrying? So I think from that perspective, and that falls squarely in the governance element of ESG, I think that there'll be a lot of attention on employees and this whole idea of essential workers. I mean, we've now seen in very sharp relief that there, for those of us that are working from home, we're actually highly reliant on people to provide, and frontline workers to provide services to us through their companies. And the question being, are they being adequately compensated for the risks that they're taking? I don't think any of these employees ever took these jobs thinking that on top of everything else that they'd be undertaking health risks. And so I think that will actually get at some of the S issues of ESG. And finally, on the E element of it, we still don't know to what extent is there an environmental factor that's actually driving COVID-19. But I think in general, that question will get asked. And as we think about the prevalence or the likelihood of future pandemics, how does our environment factor into this? So I think this will be a fact. COVID-19 will drive more focus on these things. I think it'll drive it in a good way, because not so much around let's create a COVID-19 product, but how do we think about when something as pervasive as COVID-19 strikes, are companies actually prepared for it? And if they put in place the kinds of resiliency, the kinds of steps and actions for their employees that make sense.
Thank you, Ron. And may I just invite you, Cathy?
Yeah, I'll just add that I had a question posed to me by a client about 2 months ago who asked me, so does COVID actually reveal to the world that the Japanese corporate model is actually the better model, meaning that having cash on the balance sheet, treating your employees, more kindly, like not slashing headcount the minute your revenues fall. And I actually had to think about that for a second. I said, I could see, why this person was saying this to me, because indeed we have seen, in fact, that to be, play out to be true in many markets, right? Those companies that had healthier balance sheets that were able to sustain, morale among the employees, the health of the employees, that managed their supply chains or the diversification of those supply chains very efficiently actually, perform better. So I'm not, what I said earlier about, Japanese companies have too much cash and need to do something with it. Of course, that is still true. I'm not saying that it's not, but I think there's a matter of degree here, right? And I think perhaps for those companies, for example, that same person said to me, that very common practice in the United States where, of course, interest rates are so low. So you raise debt to buy back your stock, to raise the share price, to enrich your, your leadership team. Maybe there'll be some, questions about that sort of corporate model going forward. Not that Japan is, the platinum model by any means, but maybe just thinking about a more holistic approach to running an enterprise. And you mentioned Black Lives Matter, and that's been a huge, topic of discussion in our firm, as it is in many organizations, because I think it really forces all of us to confront this very big elephant in the room, which is unconscious bias, right? It's not just about gender, but it's also about ethnicity and race. And particularly in a market like America, this is very front and center, but frankly, here in Asia, we have a lot of these issues as well, perhaps maybe a little bit less below the radar screen, but absolutely has forced conversations and dialogue that we never did before because it was uncomfortable or whatnot. But I think it's been a very healthy move in the right direction.
Well, Cathy, thank you for making a good points of of course kind of gender disparity or gap is a big issue in Japan, and you raised it over 20 years ago. But I think also in Columbia University we were very keen and spending a lot of times and efforts to addressing the racial gap adjustment, and also in a Japan context, Japanese governments are now more welcoming the people to coming into Japan and to work with us. So if we just going to progress, I think I'm pretty sure like this is becoming a very big issue. But I think for the interest of the time, I have to go to like a next questions. This is addressed. This is actually for Ron. Both Ron and Cathy said that the data is important. Transparency is important for progressing ESG. Having said that, lack of data, therefore, is the issue of ESG investing to further progress. My interview of 20 financial institutions found exactly the same. How can we solve this issue? I think specific question is the investor-led activity enough, like TCFD? Or should government need to create some regulations like Europeans are currently thinking? What do you think, Lon?
Yeah, I do agree with the point that that the lack of data is quite important, and it's impairing the ability to fully incorporate ESG completely into the investment risk framework. I do think that the first step in all this is more disclosure. Right now, in many parts of the world, that disclosure is voluntary, whether it's through something like TCFD or the SASB standards. What is good is you're seeing many corporations actually undertake this voluntary disclosure. If you think about just in a very short period of time, last 7 or 8 years, you've seen the number of companies that are filing kind of CSR reports. How are they doing in terms of social responsibility, corporate social responsibility reports? That number in the U.S. has gone up from about 11% in the S&P 500 filed such things back in the first part of the last decade to about 86, 87% today. That helps, but I think ultimately it would be good to see entities such as the FSA, the FCA, the SEC think about what are the disclosures that they want to see happen here. And for me, it's if you truly believe these things are drivers of long-term value, then you have to have some kind of disclosures on the progress that companies are making in terms of their progress along this long-term journey. Whether it's around climate, whether it's around social statistics. So I think ultimately there will need to be some new required disclosures.
Thank you. That's a very interesting. Cathy, would you like to make a comment on this, or can I go to like a next question?
Go ahead.
Okay, all right. And then the next question is to both of you. What kind of changes would you personally like to read in ESG investing? Can I ask Cathy to start?
So that's a good question. In addition to what Ron just mentioned about better quality data, because I am, after all, a research analyst and we can't do our work without good quality data. I would also say, though, that at the end of the day, just taking a step back for a second, at the end of the day, we would like to see companies and investors kind of regard ESG not as a simple box ticking exercise, but really ESG is simply the core of any successful business at the end of the day. It's about risk-adjusted performance, risk-adjusted returns, and business performance. That is kind of the core as far as we can tell. So moving away from this acronym ESG to really solving for the business rather than the label, I think is probably more important. Now, how you do that, how you measure that, how you encourage that, it's a different thing. But I worry a little bit about this being like this buzzword and sort of catchy phrase, and everybody's making products off of it. But at the end of the day, this is what managers should be doing anyway. They should be looking at risks, preparing for those potential black swans, making the business as resilient as possible, supply chains resilient as possible, all of that. So that's what I would hope to see.
Thank you. That's actually a great answer. Ron, may I ask your answer to this question?
What I'd add to Cathy's point is, in addition to management, I'd like to see this become more central for boards. That ultimately this is about long-term value. That's what the board's role is to provide independent and strong oversight of companies to achieve long-term value, and along all dimensions. It's just very startling to me that in the year 2020, we could have a situation like that, what appears to have happened at Wirecard, and what was the governance failure there, and what is it about boards that these things actually continue to happen? Do we not have the right people? Is there not the right focus? Are boards too distracted by too many regulatory concerns that are imposed upon them? But ultimately, how well the company is being governed is a fundamental tenet of the board's obligation. And so I'd like to see the boards take this really as part of their central role.
Thank you very much, Ron. As I'm on the board of a couple of companies, I'll just definitely keep in mind and try to do my best. Giving interest of the time, this is my last questions. May I have your takeaway of today? Very brief, and Cathy and Ron. Can I just start with Cathy?
Sure. So when I wrote about Womenomics initially 21 years ago, the word diversity was not part of the Japanese vernacular, whereas today, now it's pretty mainstream and common to read about it, to talk about it. I think the same thing is going to happen to ESG, frankly. As Ron said, I think it's already mainstream. People haven't kind of recognized it as such, but I think it's no longer going to be a buzzword or a fad, but it's going to be part and parcel of how businesses are operating, how investment managers look at businesses in future. So I think it's really imperative for long-term sustainability and the well-being both of businesses and communities.
Well, thank you, Cathy. May I ask Lon?
Yeah, what I would add to that is that I would hope that we've arrived at a spot now where ESG and profits can actually live in the same space, that it's not an or, but it's an and that really ESG is about how are we ensuring that companies are creating long-term value, not just short-term value.
Thank you, Lon. Thank you, Cathy. It is very exciting to learn from both of you. Thank you very much. I know you are quite busy, and thank you for generously sharing your perspective, your experience, and your advice to all of us. Before we finish today's webinar, I would like to introduce two upcoming SIJEP's webinars. The next one is next week, July 20th. We will be having Minister Nishimura, who is currently leading the COVID-19 issues in Japan, along with the Columbia Business School's the Emeritus Frank Hubbard. Please register. And the next one is the August 5th. We will have the Governor Kuroda, Bank of Japan, as well as the former chairman of FRB, Janet Yellen. Those two webinars will be moderated by the Professor Ito. This webinar is possible having the support from the SIJEB's corporate and individual sponsored. I'd like to take this opportunity to thank you for your support. Again, thank you, Ron and Cathy. Thank you, all of you, for joining us today. Have a nice rest of the day.
Thank you.
Thank you, Ron. Thank you, Cathy. Bye now.
Thank you.